welcome to the Capital Discussions Roundtable. I'm Tom Nunemaker with our guest Andrew Falde of SMB Capital. Before we get started, Capital Discussions is not a broker-dealer or an investment advisor. This presentation is for educational purposes only. We don't know your situation and have no way of knowing what level of risk is appropriate for you. We're not making any specific trade recommendations. The risk of loss in trading options can be substantial, so please be aware of all of your risks prior to placing any trades. Hypothetical computer-simulated trades are believed to be accurately represented. However, actual profit or loss may vary due to market factors such as liquidity, slippage, and commissions. So with that out of the way, and this is for educational purposes only, I will transfer control to you, Andrew, and welcome you back. It's been a little while, but it's always a pleasure to have you as a guest speaker.
Thank you. Glad to be here. I'm very glad for the work that you do in Capital Discussions, the high-quality, real content that's produced, the forum, and the I'm trying to think of the right word here, non-hypiness.
Yeah, we're all just real traders trying to make money and sharing our experiences, and as Dan Sheridan used to say, to learn the craft and just be better craftsmen.
Exactly. All right, and because of that and your good culture, I'm honored to be here and glad that you consider me to be part of that.
Definitely.
I'm just getting my screen prepared to share, and now I can share it.
Okay.
Oh, I can't do a screen area, so I got to start over and go to a smaller screen, so the resolution isn't too terrible. I'm used to Click Meeting where it does an area.
Can do like a region? Okay.
Yeah. It just, I think, allows a little bit kind of, you can zoom in, makes the font bigger for people. All right, so I got option view coming up here. All right, we're not going to spend too much time in here because option
nice
view doesn't
clear,
cover
though.
the, yeah, go ahead.
Yeah, it's clear. We can definitely read everything.
Oh, good. All right. So, I don't know if everybody knows, I didn't see it in the email, but the topic is, and I'm trying to remember the exact phrasing, it's more or less how to fill a seven-figure trade, how to enter
a seven-figure trade and get a good fill.
That's right. How to enter a seven-figure trade and get a good fill. I decided to talk about that today because at SMB, at Capital Discussions, in personal conversations about option strategies, there is often presentations and discussions about backtests and strategy ideas. And we pull up OptionNet Explorer or Option View, and we talk about historical examples. We talk about rule sets. We may even be sharing live trade strategies that we use, and even talk about real results. But a lot of times we are talking about this hypothetical, historical, back-tested data. And without fail, I think every time I present on something like that or am watching a presentation where an actual list of trades is presented and results are shown of a study, of a backtest, somebody will intelligently and responsibly ask, but what about slippage? What slippage number did you use? Did you use 5 cents, 10 cents, that kind of thing? That's usually the number you can plug in when you're doing a study of a backtest, especially an OptionNet. I think that's something you can default or even change manually for each trade, is add some kind of synthetic or assumed slippage number. And I've often said, when I've been asked that, I say I don't include any type of slippage number because I don't think there's much validity to that. I don't think adding 5 cents to a spread or 10 cents or any other number is the right way to go about it. And that's because sometimes that can, especially in my automated studies of directional systems on equities, sometimes adding that kind of slippage actually makes it worse than the real world. There are real world fills that are quite better than assuming a penny slippage on a tight equity. like SPY or something like that. VXX is one that I trade. So sometimes it's not really required in the real world. And without seeing it, you don't really know that's true. And then you have this catch-22 of, or a pickle, if you're a baseball fan, of, how do I proceed without knowing that, with that risk? And how do and you just don't know how to proceed. How do I proceed without really knowing the risks of slippage, as the term is often called? We often hear the word slippage used. However, I believe that's inaccurately used. That's related to market orders. If you send a market order, that's about the only time you can get slipped on something. It's really a liquidity and price point negotiation issue. And we can do semantics all day long, but it's more about what price am I really going to get versus the theoretical price that I should have gotten based on my system or study. So that's why I said, okay, I'm going to talk about this today, about filling these trades, because I produce backtests, I study what I trade historically, I create an equity curve, I work very hard to make sure it's not curve fit, I make sure it's robust, that I can change the parameters by large variations and still have something that works. And once I have that level of confidence, I'll move on and be trading it. And now I have the benefit, I'm on the other side of multiple years of returns, that I can go back and say, I now have no question in my mind, does this perform or has it performed in real world execution like I assumed it would in the backtest? I didn't curve fit because my out of sample results, and when I say out of sample, I mean truly out of sample in the real world. So live trading out after the study was done, live trading of those results are positive, and there's no significant variation. So I wanted to go through the process that I use to get a good fill. Not that it's the most important thing, but I do realize that at this point in time, for many of you, I'm just a voice on the internet, and that's not really like a lot of credential, but this is just a quick, I'm just going to bring it for 1 second and show you that this is $1 million IB account. You can see I have 175 broken wing butterflies in the SPX, all just 3 strikes. That's all I have. 3 strikes here out in February where there was very little open interest. Just as a side, I have these other automated trades feeding into the system as well. But this is something I do. This is the IB account. I also have TD Ameritrade accounts and a prop firm account at S&B Capital, like Tom mentioned, and those are different accounts than this. But this is where I have the larger positions, and then I pretty much duplicate that in some other accounts as well. So I do have experience filling $600,000, $700,000 in a single day, in a single hour of total risk. So it'd be the absolute max loss of a trade. Getting it filled within not minutes, but 30 minutes to an hour is about the typical time frame, and that includes distractions. That includes probably answering emails or a phone call or somebody walking into my office. Or Slack chatting or whatever else. So usually it's a 30 minutes, hour-long process because I'm just taking my time and being patient about evaluating the spread that I want to put on, making sure that I understand what I expect the true value of that to be, not just trust some quoted mid-price from the broker, and then going through my process of negotiating that spread to get a good fill by first starting with small orders and then ramping up. I used to split things up and trade in very small numbers of contracts, and then now I pretty much just do 1 or 2 contracts to make sure it doesn't fill right away, make sure I didn't mess up. And once I know that I'm kind of really negotiating, it's not like I'm just getting duped into paying a bad price. I actually at this point now start to throw out the majority or a large portion of what I expect to fill that day in a single order. And then there's some other nuances to that. Sometimes I'll cancel and replace with a smaller order, and that'll fill. So then I'm kind of learning something about the liquidity and the max size that the algorithms that I'm on the other side of are willing to take, and moving on from that. So I have some kind of off-screen notes that I'm going to go through, and then kind of walk you through this little process. The first, if you're taking notes, you might want to just write it down, but what I'm going to do is actually just show you platforms. I'm just going to go straight into the brokers platforms. One thing I forgot to do is I do want to also have option. I don't need I do need OptionNet. So I need to pull up OptionNet as well, just because it's faster for going back in time. LastPass is not cooperating. There we go. Copy password. Sorry for the delay. So the first thing I do is get multiple quotes. All right, and that's what I'm going to be doing next here. All right, so this is just a little TD Ameritrade account I have. I take some small positions in it, just a little discretionary account. But I like to have TD up because it's sometimes just the fastest way to get quotes and pull up a chart of something. So I'll have that available, and then I have OptionNet Explorer. And I'm getting my data for OptionNet Explorer from TD, so it's kind of like a double thing. However, sometimes what happens, well, not sometimes, all the time, the delta strikes are often different. So what I'm going to do is I'm going to model my 60-40-20 trade and then go through the steps that I use to fill it. So if you're taking notes, I'm going to kind of gloss over real quick. And what I can even do is just kind of open up a quick Word doc here and just type these out for you. So I'll just kind of zoom in and type these out for you. So first, I get multiple quotes. Second, I get historical quotes. Third, I get synthetic quotes. At some point, when you start typing the same word over and over again, you probably just drop it out. And then I get nearby strikes. And then I get nearby expirations. Now, this is kind of the ideal process, and there's probably actually even a higher ideal to do more than this. I don't always do all of this, but this would be, if I'm really being careful, I'm going to go through all of these, and then maybe even kind of a multi-dimensional way of going through all of them in a couple different ways. So this is all under the headline of price expectation. All right, what do you expect to get filled at? And then I go into negotiating. And we'll get to that in a minute. All right. So first, we're going to get multiple quotes. And I'll bring this back up and tell you what I'm going to get quotes of. I'm going to get multiple quotes of my 60-40-20 delta BWB, Broken Wing Butterfly, I'm just going to say that. I'll show you exactly which one I'm going to look at. So I can.
Hey, Andrew, before you go too far, there was a question. What is a 60-40-20 butterfly?
Okay, I'll give you the short version because I think I talked about it very briefly on a capital discussions before. I've talked about an options tribe, and I go over it frequently in the options strategy workshop as well. So I'm not pitching those things. What I'm saying is if you find interest in this and you want to go deep for hours of information, then that's where you can go. But it's a 60 delta, a 40 delta, and a 20 delta. This is a live version that I have on now. So when I put this on, this strike was 60, this strike was 40, this strike was 20, or something near that. I do modify exactly where that is, depending on market conditions. So I think when I put this one on was after the election, possibly. I can go check. Actually, I think it was before. Let's look at the trade log. I added to it there. No, I rolled it. I've rolled this one because the market went up so much. I've got 2 trades in there. I got to split them out. But anyways, 60, 40, 20. Sometimes I slide the whole position around, depending on if a little bit of mean reversion assumptions. But 60 delta, 40 delta, 20 delta, more than 60 days expiration, and then there's literally dozens of ways to handle the trade after that. All can be 100% rule-based. You can do a % change in delta. You can do a simple stop and limit. You can do a time stop. You can do a combination of those. And I've done thousands of combinations of studies and had assistance in doing thousands of combinations of studies over 5 and 10 year periods of time that show that many versions work. It's just a robust trade. It is, I would call it a close cousin to the road trip trade. But I just don't use any of the specific rules of the road trip trade. But it's, when you look at it, it's very similar because a broken butterfly is just a very robust starting point. After that, there's just a lot of different ways to handle it to try to increase your expectancy and reduce drawdown. So, what I'm going to do is kind of start a new model. This is weird. I usually do not do presentations in option view because it tends to be unfriendly.
You know, you can drag that center bar between the calls and the puts higher just to show only the puts.
Tom, there we go. I love this. This is proof right here of why, or the evidence right here of why I like doing presentations. Somebody will say, why do you?
Personally, I just drag it all the way up to the top and don't show.
Yeah, because you don't use calls. Yeah.
Yeah.
Man, this is why I share, because invariably you get something back that you didn't have before.
Now, if you click on that down arrow on the right, you might be able to see all your open strikes.
Almost. Let's see. It's a little too far.
Yeah, a little bit too wide. But
yeah. So, but I'm going to be up here in a different position here. That's right, Michael. That's why I'm here. I expect to learn something new eventually. Maybe not today, but I did today. So here we go. I'm just going to throw something on here. I stopped the quotes, but I actually don't want to because that's kind of the point here. All right, so 64. And now here's the other thing. I don't really like the delta strikes that I get in option view. So, but I'm just kind of putting this on here. All right. I don't know why the dot's up there. That's another reason I don't. It's just weird. Like, all of a sudden the dot, do you know why that would be? It's just not.
Yeah, it's probably got the some of the P&L from the other position in there.
Ah. I see. I just have to start a new trade. Okay, so I'll just ignore that. Yeah, that's probably about right. So this sometime model. Now, if this is all you use, then this is all you have to work with. And you can say, all right, let me just kind of go to price, drag around here, so it looks like 585. I guess that's the price. And if that's all you go with, depending on your data feed, you don't really have a lot of confidence that 585 is what you should pay. And you can start throwing out orders and go from there, but maybe it's not the best way to go. So now what I'm going to do is I'm going to get some opinions. All right. Before I got into the trading world, I was in commercial real estate, so I helped corporations and large investors buy shopping centers and things like that. And when you buy things and sell things, buyers of shopping centers consider themselves to be sophisticated, but they tend to go and get multiple estimates, we call them appraisals, from other people. I guess I need to go to today, actually. Do this real quick. To kind of gauge where the market is. When you have an illiquid market, you want to get multiple quotes. All right? And that's what we have. We have an illiquid market. And because of that, the bid-ask spreads are so wide. The process that brokers use to give you a mid-price is not always the same. Now, if somebody's studied this in greater detail than I have, I'm more than happy for you to chime in. This is just my experience. At the end of the day, it's a profitable experience. So even if I technically say something wrong, whatever I'm trying to communicate to you should have value. But if somebody technically knows something I'm saying is wrong, I would be glad to hear the difference. All right, so we're going to have this one. I'm just making sure I get the same expiration. So 79 days according to option view. Same here. And I'm going to go, I'm not going to match strikes. I'm going to go check what option net now says is my 60-40-20 trade. Now, option net is where I developed this trade initially. So I'm going to tend to go with their values. So let's see what strikes we have here. We have 2075, 2180, 2250. And then here we have not the same strikes, and that's usually the case. So it's $5 higher in option view, and that would just be some rounding. 2175. 27, yep. So it's $5 higher, and then $10 higher on the upper. Now, sometimes that's just the rounding of the delta, depending on what was available. So there's kind of two trades there. And then I can go look and see what's my max risk on this trade. This is one of those things that's easier to see in Thinkorswim. But here I can just kind of go way off to the side and see it's 42. Or actually, current margin on this model actually just demonstrates that. Is 42,000 would be the cost of that trade. And then here, profit and loss, I go off and I have a very different number because I have different strikes. So I have to make a decision now. Say, I know I like the 60 delta 40, 60, 40, 20. Which strikes am I going to use? Okay. And at some point, I need to select the strikes and then start getting apples to apples. So what I'm going to do is I'm going to go ahead and match up my option net strikes where the system was developed and match those in option view. So this is going to be here. The upper is going to be 2250. Oh, okay. Good thing it isn't that one because there's no number there right now. I don't feel like messing with it. 10, sorry, I got to do this, minus 20. And then, so I have 2250, 2180, 2080. And that's the same strikes I have here in option net. Okay? So say, what are these two data streams? Actually, I think these are getting live data from the same place, so they should be the same value. So $37,000 cost, $37,921. But over here, I got this $42,139. I have two different numbers. All right. Now let me pull up TOS, and we'll do the same thing. TOS quotes it as 78 days, so that would be number of trading days left, not number of days till expiration. I don't think they changed that not long ago. IB has been doing that for a while. They do number of days you can trade until the end. And then so 20, 250, 2180. I think it was 2080, right? Yeah. Analyze. What is this? I didn't get that. Okay. All right, and here I actually got just a nice actual price quote. It's one reason I like TOS. So I'm getting the 37.8 from TOS right now. All right, so this is a trade I like. This is a trade I've studied. This is a trade I know how to manage, and I like it. So I have the 780 price here, and you're going to see that's going to start moving around. I'm going to pull back up option net. Does option net give you a price of the spread, or do you just have to infer it?
I don't know. I don't use option net.
Oh, okay. 42,020 as the risk, and here's 37.6. So we have two different numbers. All right. TOS is giving me the better number as far as the cost here, and I can see this is fluctuating here at 785. And I am nearly certain, I'm just going to double check. Somebody's chatting like they're, oh, good job, Eric. Okay, commit trade. Thank you. 7:45 is what I'm being told right now. And let me see this. I just want to make sure. Yeah, I'm even getting the data from the same source. But all that we have are 2 numbers, right? Or 3 numbers. We have a lot of numbers, actually. Say, where is this price coming from? Anybody know where these prices are coming from? What is being used to calculate price? Cue the Jeopardy music. If anybody knows, put that in. There are a few numbers that we look at. And then I can't remember exactly, how do I get the, should open the level 2 here. We have 2 numbers that are often shown. Very frequently, it's usually the first 2 numbers you see. You have the bid and the ask. Okay? So I can come in here and see, all right, this 810, now this number just jumped to 810. One of the reasons for that is we can see the market moving. All right, so the market can be moving. Another reason it can move around a lot is going to be because the bid and ask change on these strikes. So if I go in here at 20, let me go to the lowest strike here, 2080. Say 2110, 2010, 2020. See, the bid and ask are changing on this. It's currently $1 wide, and then probably not too long from now, it will change again. And trade grid, it should be right there. I thought it should pop up. There it is. So here's your trade grid. So this is your bid and ask, 20 and 30 cents. There it is. It just moved. Now it's a 90-cent spread. So the people bidding and offering on this individual strike are changing their quotes, and that is moving the price of that. And every time just that one strike changes, the entire butterfly spread changes. There's a third value. Yeah, I clicked on it before, and it just was minimized, so I missed it popping in. So here, now they just dropped the bid 20 cents. So we have a $1.10 wide spread, and the spread is changing. The actual butterfly is changing again. So this price is all over the place, and it's a moving target. When you back test, and you do a lot of study, and you're kind of in the learning phase, you do a lot of back testing and not a lot of trading, and then you move from back testing environment into the real world, this becomes a little unsettling because you're used to numbers that aren't moving. In back testing, like that is the number, and you just fill the order. And then you click to the next day or the next minute, whatever you want to do for your back testing. Then you get in the real world and you say, okay, it was just 780 and now it's 820. Then that's a big deal. If you're going to fill 100 contracts or whatever, if you're going to fill 10 instead of 15 or 5 contracts, whatever the scaling is for you, that's a lot of jumping around in P&L or in price points. And then you start to look and get even more scared. You say, look at the spread here. The mid is 775 or 820. It's somewhere between those two. And the natural price is all the way up to 10. So this thing's bouncing all over the place, and I'm not really sure what I think the right price is. Okay? So now I'm going to finish going through this process and say, how do I feel confident that I fill these? And my experience is I go through this process, I fill the order, and there's been many times I've sent 120 contract butterfly, and it got filled, and it immediately showed either no P&L or actually a slight gain, because I may have actually gotten filled below the mid, and the trade never once was quoted as a negative value. Never once. And then 1, 2, 3 weeks later, I close it for a profit, somewhere near the mid, somewhere better than the mid, somewhere worse than the mid, it doesn't matter. And I move on, and I had a winning trade. So if you negotiate properly, and you don't just trust the mid, you may actually do better than the mid. You may actually not experience any type of quote-unquote slippage. That would be a cost. You don't necessarily have to experience that. It's not a given. It's not something that has to happen. So let's take a look. So $8. All right. So that's one. Multiple quotes. Okay. So I've looked at option net. Now I have to go to here. Okay. So I want to now get the quote from IB. So I'm going to go to Strategy Builder, and this is the less fun way to get something, but it works. Actually, I don't like Strategy Builder. I like that for exiting. I don't like it for building. So option chain. Okay, and then move up here. I think I have these memorized. 2250. What? 20. Just move this out of the way so I can see my other strikes here. Yeah. 2250. Then 2180. And then 2080. Okay, so those strikes are in. Last trading day, so it's not the day of expiration, but it's the last day you can actually trade the spread, is, I believe, the 16th. Yes. OptionNet calls it the 17th because that's the actual day of expiration. Now I click Strategy Builder, buy one, sell one, buy one, change my ratio. And this is where I'm hoping. Please, somebody tell me I'm doing this the long way, and there's a better way to do it. So here, of course, you know, being a broker-dealer, they throw me in at the ask. All right, so they say, yeah, you want to pay $11? I don't know. I don't know if that's the right way to do it. When you're trading in equity, it would be the way to make sure you're getting out of the trade, I guess, or make sure you get in this marketable limit order at the ask, paying $11. I just think that's ridiculous. So obviously, I can just kind of click on the mid, and I can see now, every time I kind of click and unclick, you can see where the mid is. So we're at 8:15. I don't think, was it? I don't think it'll move around. Will it move around? This is one of those, I see it all the time and then just forget. So no, it won't. So here's 8:10 because I lock it in. If I actually place an order, what I can do is just go way down here at 6 and submit this. And then I can actually just track it. All right, so now this should be sitting in my order. Where's my single? Here it is. Well, no, it won't be. I still have to click on it. It's kind of annoying. So 8:55. Do you see I just moved the mid? I put this in at 6:15. I'm now the bid. IB has moved the spread, the midpoint, to 8:55. Now that's a big representation here of how you cannot trust the midpoint of these quotes. If I cancel my order, now TD, what's funny over here, they're not going to the same mid. Look at this mid, 785 and TD, so 785 at TD and 835 at Interactive Brokers. They both, on the same spread, they have a different mid, varied by that much. Now, if I, unfortunately, what happens is I have to rebuild. Kind of a pain, but I go to Option Chain, SPX, and then hopefully you'll be able to see this happen. Strategy Builder, buy, sell, buy. Okay, 8:55 mid. So I'm going to try to, in a very short period of time, I'm going to cancel my bid in there and see the mid price go back. All right, so I'm going to cancel this, and then now the mid dropped back to 790. All right.
Yeah,
so
if anybody at IB has an order for a spread, it will affect the mid. But if nobody does, then it doesn't affect it.
Correct.
So you just have to be careful. Yeah.
So at IB, they allow any order, any resting order on a spread to affect the mid. Sometimes I think it's of every strike. From what I've seen, it looks like almost every strike can be affected. So if somebody places just a higher bid on the lowest wing, they'll actually move the entire spread of that. Whereas TD, what I think they're doing is they're only using the market maker bid and ask. I don't know if that's for certain, but that is my interpretation of how I've watched this happen over and over again. So here we see IB's at 790, and they actually now have the better price. Okay.
Yeah, I think IB uses the NBBO for all the mid prices.
Exactly. So the best bid, so the highest bid and the lowest offer, and TD is using, I think, some type of just market maker only pricing, where I can't go in there and mess up the price of a spread by just putting in a single bid. That said, or it could just be a customer-based change where IB is showing customer orders. I don't know. I don't know for sure, but all I know is these prices can be all over the place. Now that we're sufficiently uncertain about what this spread's really worth, here's the next step that I take. I learned this one from Seth Freudberg, and he obviously learned it from somebody else. So I don't know who to give original credit to, but if somebody knows, they can chime in. So here's 785, which represents $37,850 of risk. Okay. Now I'm going to change this to calls. All right, it's off the screen, but I'm changing this to calls. And that's $37,750 of risk. Okay, so right now 850. So the put quote at 785 is $100 more risk on 10 contracts. Not very different. So what I'm seeing now is, now that I've taken the synthetic equivalent, all right, and you see that the profile doesn't really change. So here's puts, here's calls. We have a little bit of skew difference in these wings over here, but the expiration graph does not change, and the very, very near the market T+0 does not change very much as well. It's really the skew of the call and put chain separately. So what I see is there's not, now the price changes dramatically, but I'm looking at the risk. Okay, just make sure you understand that. If you just look at the price, one is 785 and one is 37, that doesn't matter, because what's going on here is these calls, I'm buying these way, way in the money calls, selling some just in the money and buying some out. So that's going to be expensive because these are very expensive. And then I'm selling double of the cheaper and buying some that are kind of expensive too. If I switch to puts, what happens is I'm buying slightly in the money, selling near the money, and then buying way, way out of the money. So all my debit is this upper risk here. 785 of risk up here because I'm buying puts. And then when I switch to calls, my price is actually based on this value over here because I'm buying this call and then putting a spread above it. So that's not the most important. What I'm really getting at here is I'm going to watch this 38, okay, 38,050, and then I'm going to switch it back to puts, 38,000. So we're really, really close. We're in a $50 difference here at $8. Now I'm thinking this is right in the right range, $7.90, $8. And then the whole time I can be looking over here and see what's the market doing, because that's going to affect it too. It's not like I'm just waiting for these bids to change, this quote price to change. If the market starts moving up, this might get cheaper on the way up here. If volatility comes out faster than the market goes up, and that's a whole other conversation about what volatility comes out. But anyways, this could become more expensive, meaning the line kind of rises this way, expiration drops, we move this way. But market movement is going to affect this price as well. But the synthetic equivalent should continuously track very similar, 37.9, and then the calls are 37.950. So I know we're in the right range. Now I have some confidence. $7.90 to $8 is a good price point. if I had just gone to IB and they were quoting me 825, and then I put out an order for 810 and got filled immediately, that would be the wrong way to go about this. You'd say, why did I get filled so quick? Not very happy about it. Okay. So now I'm going to step you through. Again, this is a little discretionary account, so I don't have to keep track of these like I would with my other account. So now I'm going to walk through. Oh, let me just check my notes here, see where we're at. So we have now achieved multiple quotes. Okay. Boom, that's done. Now we're going to do historical quotes. So this one's kind of fun. This is the same spread. The only issue is we got a little bit different price. So somebody taught me today. I can just do. Oh, here's one reason I have a different price. I have the strikes wrong. $785. All right, so I'm going to go ahead and pop this up to $790 and then save it. All right, so that's now a committed trade in the current market simulator, or it's just a model trade that I've committed. And now what I can do is go back and see what has this trade been historically, just to kind of get a sense of, am I kind of chasing this spread? Whoops. Oh, I did it wrong. I'm such a doofus. Let me delete that. Let me start this over. You do not commit the trade. So I get to do this again. So here, this one I can't drag up and down, right?
I don't think so, no.
All right. Let's talk to Andy about that. 2250. Looks like bought some EDC on the automated system. Okay. And then 2080. All right, so now I don't commit the trade. All right. And what I can do now is go back. 37,840 is the current margin requirement for this. Now I can go back and see kind of where it's been. It cost 38,000, that was the risk before, so it's just a little bit cheaper. No, more expensive. It's actually a little bit more expensive yesterday, according to this quote at the end of yesterday. The day before that was in a similar range, so this spread has not moved a lot, according to OptionNet Explorer's historic data. Okay, then I can even jump around by hour, 37.1, 37.2. So now I'm just jumping around a couple hours back to last Friday. Now, the last Friday was a half day, so skip Thursday, go to Wednesday, see where we were at that point. Now, the market was lower, I believe. 2201. Where are we at now? Just a little lower, 7 points lower. And the spread was still in the same range. All right, so this spread has not moved a lot in the last few days. All right, so I now have looked back at history, and you could do this in a little more detail if you want. But I have now, that's one way that I do that. I actually use OptionNet. You can use OptionView, and just go back like a back test with the same strikes and see what could I have paid yesterday? What could I have paid a couple hours ago? Actually, you can't. I don't think you can do hours on the day of, but yesterday afternoon, yesterday morning, last week. And then also you have to take into consideration the market movement that would change the price, but just kind of get a sense of where it's been. And that will just give you a little bit more confidence. I'm going to call this kind of a part of the ideal, but it's not a necessary thing. But I do like to kind of see, am I really chasing this thing? Does this thing get a lot more expensive in the last day or two? And just kind of make sure I know why that would be the case. Synthetic, we already talked about. That's looking at the calls as well as the puts. So you look at a put spread, you switch it to a call spread. You can even go a third time and turn it into an iron spread. and then get that quote. That's probably a little bit extreme, but that's another way to do it. Maybe if you have a more complex spread or an iron condor or whatever, you can just kind of make it a condor, make it an iron condor, make it a condor iron butterfly. And what you're looking at, what will happen there is you'll get an enormous credit quoted to you, but you're looking at the total risk in the trade. All right, so the next step here is nearby strikes. So there's a couple things I want to look at for nearby strikes. I want to see in the spread that I'm considering a little bit of the liquidity, today's volume, the open interest, maybe the current bid and offer, etc. All right, so we are $22.50. Generally speaking, a round $50 strike like this, the 50 instead of 40 or 60, that tends to be a little more volume and open interest. But here we see today no volume and 64 open interest. Now this can be a concern. So there were 78 days expiration. We're looking at in-the-money puts, and there are 64 open interest on this contract. Seems like an illiquid situation. No volume today. That can be an issue when it comes to being quoted. When it comes to actually getting filled, somebody has to start the music and get these contracts going. And that's been me. It's been other people before. But I have entered markets with being the first person to open the contract. So at some point, maybe I was the one opening the 22.75 strike. 0 open interest, 0 volume. And I can, with confidence, through this process, know that I'm going to get a good price there, especially as part of a spread. So this is not a big issue. So, but going back to this little thing here about nearby strikes. So this 2080 or 780, what I can do is I can right click and duplicate. I'm just reading this question here. I'll just come back. I'll come back and do it.
For Daryl's question?
Yeah, I'll just go back.
Okay.
All right, so here I've just got this order duplicated. And then what I'm going to do is I'm going to drop it $10. I lost track of where I was. 2080 becomes 2070. Okay. And then I'm going to duplicate it again. Actually, I'm going to do this analyze trade, so I don't have to do a two-step thing. And I'm going to move it up $10. All right. By the way, this is my plan for when, so trade bigger and bigger. If I have any concern, I'm going to start just putting out substantially similar trades that are just at slightly different strikes and just start feeding them out there at different points. So what I'm looking for now is kind of a trend in price and make sure I'm not having an outlier. I'm really kind of beating a dead horse here. I don't think I would really have to go through much more of a process, but it does kind of help me. Maybe this is the only thing you do. All right, is look at this, these similar strikes. And maybe you say, oh, you know what, I actually like that trade better. All right, so here's our original trade. Here's the one that's 10 points lower. Okay, it's going to cost 70 cents less on this upside debit. So 37.30 risk. The next one up here is 37.95, so it's actually a little less risk. All right, and then I can go to this one that's actually 10 points higher, and I'm a little bit more centered in the spread. So there's some differences here. And 38.75 versus our original 30, so that one becomes more expensive. I probably knew that, I just had to look at it. So I'm going to look for this trend. I could have done it in order and had a little bit clearer trend, but this is the higher, middle, and low. All right. So we have this dollar point difference, and then it's going to be not another dollar cheaper, but it's going to be another increment cheaper, but a little less cheaper, a little less discount as you drop down further here. But $1 cheaper and then 70 cents cheaper is about what we're seeing. And then you can go through this entire process again. I can look at the synthetic equivalent, I can look at the historic prices, and I can just get a sense of these. Now, if you wanted, and this is something I do want to do, this is literally one of my written objectives for 2017, is to start, if I want to do this first trade, this is the trade I like, then I actually am going to go ahead and start doing these trades at the same time. And not in the same size or necessarily a third each or anything like that. But I just want to start negotiating these and get more reps in, as Bella would say, get more reps in for negotiating a spread. And say, am I really getting good prices here? And track those individual spreads and kind of see how the price changes are. Here you can see it's a $1.10 spread now. So I say, okay, well, this one's, maybe it's a little cheaper. This one's a more expensive spread, whatever. And I can go through this process and observe getting fills, negotiating the spread, trying different sizes, and kind of see what tends to work. But for today, what I'll go ahead and do is just, I'll stick with the original spread we had, just to keep it simple. And then, all right, so those nearby strikes, and then I'm going to switch these back to the same strikes. 2250, 80. Actually, that's a slower way to do it. Let me just get rid of these. Just have all these modeled trades in here. Okay, and then I'm just going to analyze trade and then analyze it again. And then what I can do is just move it out a week and then in a week. Actually, it's a couple weeks. Oh, and it's not traded, so that doesn't help. All right, so in a month. That one's not traded either. Got the March. Okay, so now I'm looking at January, February, and March on these, and I can look to see if I see a pattern as well. And I can say this March trade is very cheap. All right, let's look at this guy. Nice, and look at that flat line. I just really like contracts with a lot of time to expiration. Great risk reward. So only 460. 30 days later, a 30-day cheaper spread, about a 1 month cheaper spread, is 790, and a 1 month cheaper spread than that is 1150. All right, and I can just kind of look at this pattern here and see what's going on. Something I wasn't planning to say, and we don't have a lot of time, but I'll just quickly mention it, is you can actually start to look at volatility skew as well. Look at the individual volatilities of each expiration, and I have that up at all times right here. So this is the implied volatility historically plotted of these various expirations of December, January, February, and now I can actually add March. Any day now. Maybe I'll drop. Okay, it worked. Okay. So here's the individual implied volatilities. You can see the longer dated tends to be more stable, higher and stable. So it's kind of up where it's always been, dropping very slowly like it tends to do as it drifts. And then you can see the spread, and then sometimes we get into backwardation with the front month actually being higher. But keeping track of where that is, just to make sure, especially if you trade near to expiration, make sure you're not getting on the wrong side of a really big spread in implied volatilities, where you might be kind of stepping in front of some mean reversion there. So we've now covered nearby strikes, we've covered nearby expirations, and then we get into negotiating. All right, we looked at the bid and ask, we looked at volume and open interest, and at this point I'm feeling confident that this is a good trade. I don't look at this count. Okay, I have a little bit of. Now I'm not going to demonstrate this today as far as large size goes. but I'll just do it with a single contract and show you. So the first thing I do is I come in not way, way, way crazy below, but a little bit below. All right, so let's go down at 740. And then for fun, if you think this kind of thing is fun, I'm going to have this IB quote up here as well. So they're calling 8 the current midpoint, all right? So I'm going to throw out this 740 bid. And here I have this habit of every time I hit confirm and I'm about to click it, I just pretend like I did it all wrong and I double check. All right, so I'm checking February expiration, 2250, 2180, 2080. 740 is my bid. 790 is what I think it's worth. Okay, send that. Actually, the easiest way to watch it, which I've learned, is you lift this up and you pin it. And then you go find that, where's this? Time. Let's do that. Got to reverse my time. Here we go. All right, so this one's working, and I say cancel, replace, and then I pin this. All right. So oh, that is pinned. Okay, so this is now pinned here, and I can move. Now what I want to see is I just placed that order. What happened over here? Look at that. IB's moved it up to 9. They moved the midpoint up to 9. So this is that if you've ever had a really bad fill, you thought it was the right price. So they're saying this is $9.
Position closed.
Oh wow, VIX is going up. They're saying it's worth $9. I'll put it out at, I don't know, $8.50, and then it fills immediately, and then it shows within a few minutes that you're down a lot. You're like, what is going on? What just happened here? And then later on, you just don't know, and then it takes you 3 weeks until you get just back to break even, and you're trying to figure out what happened. This is exactly what can happen. My little one contract order has, sorry about all that noise. My little one contract butterfly spread has moved this mid. It could just be, and that's why it's kind of a random thing. These are 3 kind of unique strikes, not typical butterfly that you would see. But if you're doing an iron condor at very round numbers like 2050, 2000, 2150, 2200, there's probably a lot of people out there. And one guy can throw in there a bid or an offer and move the entire mid, and you're going to go chase that because of the single contract. So this is an order pending at TD on the exchange, moved the mid price over at IB. All right. So now what I can do is move this on up, wait till that's working again, and I just do this cancel, replace, and kind of step it up, and I monitor the mid. You see what happens? The mid here at TD is not changing. They're not letting my one little contract butterfly move the mid. Okay, I think that's possibly even a more ethical way to do it. And since we're just out of time, I'm just going to kind of work this up. Now I'm going 10 cents at a time because it's a contract and I'm not worried about it. And I just want to see it happen. So what I'll do is I'm going to move it into where I think the fair price. I think 785 is a great price. If I get filled at that price, I'm all for it. Okay, so I'm just going to leave that alone and try to look at these questions real quick. See where if you know where I left off, you can let me know.
Yeah, I think Daryl has a question about you put in a bid at below the mid and toss, but IB at the mid price is only if somebody has an order for the spread. So if there's no order for the spread already, then putting any order in is going to change the mid price at IB.
Right. So I guess what I could even do is, if I were to cancel that, we can actually experiment. I'm not going to do it. That's something you can experiment with. You can go at one broker, put a little tiny, tiny bid in on a single strike and see if it actually moves the butterfly spread. So that'd be a good experiment. Daryl, you're saying you never get better than the mid, so you're usually starting at a loss. I just encourage you to just carefully and patiently negotiate. I've let orders. I start trying to get into trades before I want to be in them. I start a couple of days, a week ahead, whatever. If I want to be into trades before it's 60 days expiration, I'll just go out a week and be in closer to 70 days expiration, 80 days. I don't care. I want to get a good price. I'll try different strikes. Like I said, I'm going to be trying to do kind of a mixed bag of butterflies. Might be throwing on the synthetic call side. Might move them up 10, down 10, kind of give a mix of spreads. And, play the market maker, play the big money game and say, I don't have to be in this. You come get me. That's what I recommend. Just make sure you take that slow. I have a feeling it's a speed thing. I could be wrong. But I've let orders sit sometimes for a couple of days and just a kind of little wiggle in the market and a little less liquidity. What's going on? No market maker is going to tell you this. So we have to infer from our experience and kind of guess what we would do in their situation. But if they think our order benefits them and it's sitting on the book and it's available, and why would it benefit them? Well, they're taking the other side of a lot of trades. So I have this, to them, it's a negative theta, positive gamma trade, okay? Maybe they have too much. Maybe they're on the wrong side of too much positive theta. And they really want some tail risk in their favor. They want some trades that make money if the market moves. They want some money. They want something that is negative theta, but not a lot of negative theta. That's my trade. The daily theta burn rate on my trade is not as quick as something with 2 weeks expiration. They may really like that. And they're not manually going through and analyzing my trade. It's a computer. A computer is scoring my position. It's determining what it thinks is a fair price. Again, I'm not the market maker. I don't know what their algorithms say, but I'm just saying what I think I would do in their position. The computer is going through and saying what's on the book that's at nearly a fair price. It's in the fair price of our range and fits as a hedge against what we have. And if it's small, if it's big, whatever, if they need a lot of it, they might take my 100 contract butterfly that's placed 20 cents below mid. And they may go ahead and pick it up because they need it. They want it. It fits their book. So I let the order sit. And there's been many, many times I've gotten 10, 15, 20 cents better. And that's the mid of the moment. It's not like I waited for the mid to move to me and I got filled. That is the mid at the moment, and I get filled at a better price. And that's the mid of what is my estimate of a fair mid, not just some artificial mid that's bouncing around for various reasons. All right. A lot of people saying the same experience, huh? All right. Well, keep working on it. Do not assume that you have to live in a world where you pay worse than mid. Try to, Bella has listed his top 10, things that successful traders do to have edge and last. One of those things on his list and various versions of the list is fight for price. The bigger you get and the more professional you get and the more that it matters, that you're just having an excellent process in your trading, not just a good strategy, but a good process, is to get a better price. So fighting for price is the name of the game, as much as your prior study of what to do.
And I think Tom Sosnoff also recommended just putting little teasers out, 1 or 2 lots, just to test where the market is before you go in with your full order.
Yeah, if I was going to do 100 contracts, I would still put this one contract out first. Kind of see what's going on, raise it all the way up to 785. Now I know this, like 785 is not a given. All right. And here, even the mid's a little bit below that right now. But if I think, all right, this is really it, I'm really comfortable with this. What I could even do, go 790 and then pop it up to 100, and then I would just send that order. And I'm totally fine with that. This account couldn't do it, so I'm not even going to try to send it.
Well, Andrew, we're a little over an hour. Is this
Okay.
a good point to wrap it up, or do you have anything else you want to cover before we call it quits?
It is. The only thing left that I would have wanted is to answer more questions, but what we can do is just actually what I will throw out there, three things I want to mention. I have an options strategy workshop that I'm doing. It's twice a month, and I just added a chat room. It's very specific to my style of trading. It's not a general chat about options trading. We talk about the 60-40-20. We talk about back testing. I'm not going to have a lot of ideas about other trades, and I'm not going to get into things like earnings trades and other things like that. But that is a great way if you want to correspond with me frequently, then you can join me there.
How do people find that?
That's on optionstribe.com on the links tab on the menu. It should be in the first 5 or 10 buttons there. It should be Options Strategy Workshop. Or just go to SMB and hit the contact form and chat in or something like that, and you'll be able to track me down with that. So you can do that. Secondly, Amy Meisner, who is frequent guest and subscription, what's it called? The alert service, right? Alert service provider through Capital Discussions. She's going to be live in New York at SMB Capital doing some training, and we're going to be filming that, and then we're going to have that for release hopefully early next year. But if you happen to be in the New York area, 2 days from now, the 2nd through, or 3 days from now, whatever that is, the 2nd through the 4th, I believe it is, she is going to be at SMB filming that. So she's mostly going to be teaching the traders on the desk in the room, and then we'll be filming that, and you can purchase that course early next year. So just want to kind of let you know what's happening on that end.
Okay. I see that Option Strategy Workshop. It says subscription price is $150. Is that per month, or what billing cycle?
Per month, but you can do a $1 first month. So if you just want to try it out, watch the archives, come into the chat for a while, you can just pay $1 and come for a month.
Gotcha. All right. Well, thank you very much, Andrew. It's always a good discussion of how to get better prices, like you say, fight for price.
Yeah. Thank you.
We look forward to having you on in the future. And if we don't talk to you before the Christmas holiday season, have a great holiday season, and I'm sure we'll see you in the near future.
All right. I hope to. Thank you.
All right. Thanks, everyone.